Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Okay, good morning, everyone. MAAM research meeting for June the 4th already, and just going to dip down into the growth capital lending space with Multiplier Cap Fund 2. Just a few updates from some of their portfolio companies, and then charts of the week. Looks like not a super detailed overview, but we'll get into that as well. The disclaimer as always. So Multiplier Cap leads our emergence fund in the area of growth equity lending. So they're putting out pretty interesting loans to companies, along with sort of an equity sleeve as well. First company comes out of Canada, Apogee IT Services. I believe they were acquired. So I did see something in the news regarding them. But this is a managed services provider. Looks like a $6 million loan with paid in kind interest, paid down to just under 4 in terms of the positioning, and the current EV at 270,000. So again, following the acquisition of the company, they no longer produce standalone financials. So when we see Apogee again, it'll sort of be a consolidated set of reporting for the parent company. And Multiplier thinks that in terms of the opportunity relative to the additional escrow funds, they'll be realized later in the year, and they're in talks with the company, obviously, regarding the equity sponsor and that sort of thing. IT services, I think, has kind of changed in the sense that there is a lot of now competition from kind of newer type companies. So we'll just have to see how that evolves. On the other hand, we all need clothing, and I don't think clothing is going to be replaced with AI anytime soon. So this is Mizzen in Maine. It's a men's clothing retailer. They reported Q1 26 gross revenues of almost $17 million. So that was pretty good, about 91% of the company's forecast, and looking pretty good in that. The thing is, the gross margins declined a little bit, down to 52%, which is still not bad from almost 60%, and that was below their 56% target. Primarily due to some of the duty-free shipments of their inventory. Operating expenses were also favorable, coming in at about $9.4 million. So they kind of tucked under their forecast amount by $420,000, and the EBITDA burn rate of $1.4 million in the quarter was a little bit higher than the $465,000 from the previous quarter, and that's mainly due to, again, that slight top line softness and margin squishing there. Cash on hand at the end of the quarter was over $2 million, and Multiplier tweaked their loan terms to really just extend the maturity by 1 year, and modify some of the calculations around the amortization schedule. The fund also charged a fee, and so anytime you get involved with these groups, there's a lot of flexibility, but you do end up paying for it, and that's sort of the area that they're in. Rocket Lawyer was basically an online legal services platform. Loan was $20 million, and I think their net sales, adjusted for some of that deferred revenue at $23 million, was right around plan, so 99% of plan, but a little bit less than last year ago's results. and margins remained consistent at 84%. So this is still a pretty interesting business. You do all of your like if you just basically download an app onto your phone, and if you don't have a will, you just click a bunch of buttons and you can have a will. I don't think, a lot of serious legal work gets done here, but certainly, business corporation registries, wills, like a basic will, the usual sort of meat and potatoes legal work that a lot of consumers and businesses need to get done can go through Rocket Lawyer, as opposed to sitting down with someone that's $1,000 an hour at at Tories or whatever. Actually, $1,000 an hour might be cheap for Tories, but in any event, OPEX was 20 mil, well, call it $21 million. That was over budget by about 867K, and that was just higher on raises and a slight increase in headcount. Cash was almost $7 million, which was more than they had modeled, so that's good. And then lastly, or second lastly, Zeal Networks, which is essentially an online wellness platform for massage therapy and other services. Um, you know, Reported another quarter that essentially spoke to stabilized financial performance. Q1 26 revenues were $11 million. So that's 104% of what they were kind of aiming for, and higher than the prior quarter's results this time last year. Um, Revenue grew about relative to the fourth quarter of 25 by 105%, and gross margins were 41%, which was in line with forecasts. Expenses, however, were almost $5 million, and that was a bit higher than what they were kind of targeting at $3 million bucks. And that's really a function of higher SG&A compared to recent quarters. So that could be a sort of a beginning of the year type of sequence. And then they posted a slight unadjusted EBITDA loss of $40,000, which was 10 grand of a miss. And cash at 588,000 seems not bad, but it could be more. And again, the company remains in default because of the fact that they've missed certain abilities to raise monies from their creditor group, including Multiplier. And so Multiplier rates all of its credits kind of high, medium, low, moderate, that kind of thing, just like we do for a lot of our internals. So that's Zeal. Room. So these are modular mini offices. To me, it looks like a phone booth or a fish tank. I don't know how you could actually work in one of these things, although I'd love to have one of these in my house. When my dog goes bananas, I could just lock myself in one of these cubes and do some real work. But just sort of looking at the results, things looked okay. I think the idea here is that there is an OFS Brands transaction that I think is slated to close. I don't think it's closed yet because they're still in discussions to take about a $2 million reserve here, and I don't know how this sort of works in general. I really don't know kind of what the, I guess, vibe, if you will, is with office space. There's still there's all these back to work mandates type of stuff, and that's fine. And then FIFA comes in, and now you're hearing about certain cities just being so congested that they're telling workers, on second thought, just stay home until all the soccer players get on their jets and go home. So that's that. Lichtenhouse is an eco-friendly producer of bedding. So you can see that on the left. They reported Q1 26 financials that were below the same quarter last year, and the Q1 25 gross and net revenues were about $5 million bucks. and 3.3 million, which were, 80, call it, percent of forecast respectively. Gross margin is still pretty good, 77%. That's nice to hear. So maybe they, need to. I do know that some of these, eco-friendly high-end products are a little bit pricey, and if you go through, betting a lot, it does add up. And then for the quarter, they reported a net operating loss of 222,000, which was a little bit worse than last year. And then cash on hand is only $103,000, but that does not factor in pending cash flows. So first quarter, not the strongest, but again, with these sorts of companies that they're selling stuff that you actually, again, can't have replaced by AI. It's more spring and summer that I think people are buying linen. Like I go to Sleep Country Canada the odd time for stuff, and I don't really do that in the heart of winter, which is where this first quarter result would have been cooked up at. Okay, so charts of the week. He's Andrew's got his usual slide deck of charts, which we'll get to real quick, but he had this really interesting thing from Bank of America that illustrated the concerns around essentially concentration. And there's a pretty good chart coming up in a few slides, so just stick with me. But Jim Bianco also talked about this issue, and actually, I was texting with a friend last night. And I think one of the things that someone's going to have to start talking about real soon is that if you look at Google, I think they booked like a $30 billion profit on their statement of operations, none of which was from people Googling. It was all from their position in Anthropic. So it was like a markup on a financial statement, which is good, but you kind of want Google Googling, right? Not making investments in stock of other companies that are pumped up. So yeah, we'll have to sort of really get focused on that over the summer. For now, S&P 500 is in the overbought zone, so that's a positive, I think. It has extended beyond this channel. Just by way of background, this channel that he outlines here goes back to the beginning of this bull market cycle, which according to Andrew is October of 22. So we had COVID, then the recovery, then the inflation, then the higher rates, and then someone decided that October of 2022 was when the market would take off, and we're outside of that range, so it's extended, and he's just pointing that out. Now, the index itself has certainly made higher highs. I think we all know that, but there is a little bit of again negative divergence brewing down below on that lower panel, whereby you don't necessarily want to start unloading stock en masse, but you do get the sense that some of the oomph is being driven by fewer and fewer companies. On the other hand, the semiconductor index just pretty much went parabolic the last couple of weeks. So this is the SOX itself. Quite frankly, I didn't realize it was this poppy. So yeah, I mean, at some point, I think you could probably expect a little bit of a cooling here. So if you're looking at semiconductor stocks, I guess the advice is just for now, just keep looking and wait for maybe a better opportunity to get in. And then the percentage of NYSE stocks above their 50-day moving average seems to be coming down a bit. So that's not the best from sort of a breadth perspective. And this is that chart from Bank of America that Andrew pointed out. Whoops, sorry, I just lost my slide there. So I really like this one. So what he does here is essentially compares concentration versus what happened next in some of the more prominent bubbles over the last call it 180, 190 years. So you could see the railroad bubble. Back at that time, 63% of the entire U.S. stock market capitalization was railway companies. Made sense at the time because that was the time when America was really building up. But the aftermath was literally, and pardon the pun, a train wreck. But then there's other ones, the Nifty 50, the utilities and telco run up, Japan. And so fast forwarding to today, you can see that AI's Big 10, and the AI Big 10 is the Mag 7 Plus, AMD, Micron, and Broadcom. So that's how you get to Big 10 from Mag 7. So it's at 40%. So it's definitely in this range of kind of historically being, a point of vulnerability for the U.S. stock market, because you've got, again, 40% now of the entire U.S. stock market is just 10 companies, which again, it's not necessarily saying to run for the hills, but it is something for sure to be aware about. And I'll pass it back to the group. Thanks.
June 4th, go through this kind of, up and down week, up and down last few weeks, but we continue to move to higher highs despite some overall weakness, I'd say. Looking at the Canadian disclaimer here, just warning, contact us. We're not giving any securities advice on this call. And then same with viewers in the US. We do have a US business, and just contact through our website or email. Just going through quickly the indices. There weren't a lot of changes, but still bullish. 2-box increase week over week for the S&P. That's created a new buy signal, which is the second straight. Year to date, up 11%. Really this week led by computer hardware, and then energy, actually, if you look at the heat map, was the second best performing subsector, or overall sector, excuse me, this week. Vertical price objective quite bullish at almost 10,000. Momentum trend reversal over the last few weeks. Like Joe said, overbought, oversold for the S&P, extremely elevated. It continues to be elevated the last 6 weeks, even with investors obviously piling in and seemingly ignoring the conflict, valuations, potential inflation, the impact of potential inflation on interest rates. So very, very positive sentiment in financial markets, while some of the economic data is a little more opaque, I'd say. Actually, funny enough, I'm kind of had some of the same highlights regarding the S&P as Joe, but you can see there that currently the top 10 in the S&P, after the runs a couple of the semi companies have made, like Micron and Broadcom in their own right, the top 10 account for almost 40% now of the S&P 500. Watch for that next year, because these indexes have changed the way they're calculating and their methodologies, and or excuse me, not the way they're calculating, but the way they include IPOs. And it's really, I think, to do with the big 3 IPOs that we could get within the next few months: SpaceX, OpenAI, and Anthropic. We could see that top 15 number kind of potentially creep towards that 50% level, where you're at this mass concentration. Nonetheless, NASDAQ 3-box increase week over week. Like I said, broad tech dominance with some really strong earnings and AI spending, increased forecast from management, really pushing the NASDAQ 100 up. It's up about 20% year to date now. It's the 5th straight week in a row. It's been at an all-time high on this chart. Strength this week really was driven by hardware and semi equipment. So couple tech sub industries. Price objective did increase. Overbought, oversold 119%. That's the 5th straight week it's been over 100. That's been extremely overbought since April 17th. and where it is at the overbought, oversold level, potential correction territory. So really watching that there. And it's been up about 33% over the last 62 days. So that's a lot of velocity in a short period after a really strong rebound after a weak, I'd say February and March. So really kind of highlighting the instability or non-sustainability of a move like that, and just kind of where we are at stage in the cycle. Looking at the Dow here, one box increase this week. It broke February's resistance, so it's at an all-time high in this chart. Really lagging the other two indices, and the dispersion between growth and value continues to widen. This chart hasn't broken negative monthly momentum. Overbought, oversold is about 58%, which is high, but not when you compare it to the growth indices, and it's the 8th straight week it's been overbought. So continue to watch the Dow for some opportunities there. Looking at the TSX 60, really the last few weeks we haven't got a lot of movement. One box increase to all-time high on this chart. Really this week the energy sector kind of led the TSX with some financial weakness over the week, with some earnings coming out. TSX 60 is up about 11% year to date, so kind of on par with the S&P 500, below the NASDAQ and above the Dow. Really, I think the TSX continues to present the strongest setup in terms of valuation, and the technical setup with some nice support lines. It's really not overstretched like the NASDAQ. It's kind of moved up slowly, if you'd say. The momentum is slowly turning around. It's not heavily overbought this week, about 64%, which is the highest since February 27th when that war began. So continue to see some value potentially above the border in financial markets, specifically equity markets. Looking here at the VIX, really flat week over week. It decreased, followed by an increase Tuesday, excuse me. I won't really reflect on that. We've still continued that downtrend over the last few months. See if it breaks that and we get a spike up in the next few weeks. Bullish percentage chart. These two charts actually have moved up, so it seems like we're continuing to move higher over the last 2 weeks, but we're at all-time highs. Micron, companies like that are up 100% year to date. The semiconductor index or semiconductor ETF are up like 60, 70, 80% in the matter of weeks to months. People are buying 3 times leveraged ETFs, but the breadth in the market, you can see here, pretty much a lack of. I mean, only 54% of the S&P 500 is trading in a bullish pattern. That's basically half. So really a lack of breadth at this point. Looking here at the NASDAQ and the Dow Jones for the percent positive trend, a little higher because these are slower moving charts, but nonetheless have continued to increase in recent weeks after bottoming out at the start of April. And then the TSX 60 kind of just flat over the last few weeks, so won't really dive too deep into that. Jumping into the asset class rankings, actually the first time energy hasn't been first amongst the commodities group since 2 weeks before the actual conflict began. Industrial metals picking up a number of buy signals, obviously. Some industrial names have performed pretty in a pretty strong way, especially the ones that are correlated with the AI trade. Some continue to forecast some increased demand in a lot of those industrial metals, so a bit of a flip there. Precious metals, complete reversal from 25 despite trading at a pretty elevated level, really down over the last few months. So that's kind of the change there within the commodities group. And then up in sectors, technology continues its ascent, has almost gained 100 buy signals. I think it's gained about 80. in the last 5 to 6 weeks, and it has finally surpassed energy for the #1 position. So continuing to see a rotation into those tech heavy, large cap funds, which is no surprise. Really, you're seeing tech and large cap growth all the way at the top there in their specific sub asset class groups. Looking here, this is just EEM. There's some commentary that Dorsey Wright wrote there. I'm just gonna talk from a high level just about EEM, which continues to move higher. Created its 5th straight buy signal. Reached $70, I think 2 days ago for the first time ever. In May it was up 25%, and it's had the 6th best start to a year since the fund's inception back in 2009. The fund score almost a perfect 6 out of 6, but where the strength is really is the relative strength relative to the market. Even though the S&P 500's continued higher, EEM on a relative basis continues to have positive momentum compared to the S&P 500. And it's been on that trend since September 2025. So that's something we continue to watch, especially with our exposure to that ETF, but also the broader emerging markets. Looking here, this is a quick chart of Taiwan and South Korea, perhaps the 2 hottest markets in the world, equity markets, that is, even hotter than the US. Obviously, both leveraged to the AI trade pretty significantly. They would be the 2 that would be hit the most if this AI quote unquote bubble does pop, even more than the US. But you can see here, I mean, just this year, since that February low, the South Korean ETF is almost up 100%. The Taiwanese ETF is, I think, up about 80%. You can see just the continued melt up and just the velocity and the movements. These indices, these iShares ETFs are very concentrated in just a few names. I think the South Korean has a huge weighting, the Samsung and a few other companies. They're both very tech heavy. We actually have been looking at South Korea for quite some time, just with the exposure it's had to AI and just the values or just the valuations that the companies were trading at compared to the US names just a few years ago. So continue to follow that area really closely. Moving on to something a little different, just the next, I think, 2 or 3 slides talk about IPOs. So I'll go through them really quickly. Just looking at how the big IPOs perform ahead of 3 of potentially the biggest IPOs ever in North America. You can see here the amount raised, which is going to be pennies compared to the SpaceX, Anthropic, and OpenAI potentially. And you can see their 7-day, 30-day, 180. These are forward, obviously, returns. Obviously, some negative returns, especially when you're looking at companies like Rivian and you know, Venture Global, some of these more recent IPOs. But then you look at a lot of names like Visa and Facebook. But just for when Facebook, even Facebook, one of the hyperscalers and mega caps right now, really did struggle for the next year, moving lower by about 31%. So you can see down here the percent positive returns. Only about 25% of these large IPOs are up after 1 year. So it does seem like there's a bit of a shorter term spike, maybe a reset, and then in the long run, 730 days out, about 60% of these names up. Looking here, just the IPO market, we're on pace last year with volume. Currently, there's about 152 IPOs this year. Last year, there was 347, relatively on pace. But in terms of the dollar size, obviously nowhere near. You can see here, these are the biggest equity sales ever. So it's Saudi Aramco, about 30 billion, I think. Petrobras, which is the Brazilian energy company, I think it was in the $68 billion range. Alphabet this week put out a $80 billion equity issuance, which even Berkshire Hathaway participated in. SpaceX is looking to raise, I think, about 75 billion. Anthropic and OpenAI are looking to raise pretty large sums of capital as well at really high valuations. So these companies seem to be racing to raise / go public. You don't really see those things happen at Markham Bottoms, so we'll have to see right now. And I think these things, specifically the IPOs, are going to perhaps ramp up volatility as we head closer to them. This is just looking at the energy ETF, looking at something a little different than tech and IPOs. Really strong move since last, well, I guess May, since the tariffs were announced. You can see the consistent buy signals. Obviously, we've got the pop this year because of the price of oil spiking, but you can see it's been in a nice channel since, where it has some support lines to the downside. Unfortunately, has some resistance to the upside, but we continue to like energy names, especially with where oil's trading at right now. A lot of these energy companies in the US and also in Canada, this is a US ETF, but a lot of the names in Canada we think are going to be cash cows for the foreseeable future, especially if prices are, let's just say, remain a little more elevated than they were compared to last year. This looking right here, this is just the price of crude and where it's moved. I zoomed it out and put a $3 scale on it. So that's why it's on a sell signal. The actual default chart has a buy signal right now, which is the dollar scale, but there's just too many movements for me. But you can see here a couple lines of support. Kind of trending lower since the highs back in April, but really been trading in this sideways pattern for the past 6 to 7 weeks, and we're okay with that right now. This is kind of a similar slide that I was talking to earlier when I was talking about the asset class rankings and 38% of the S&P 500 being the top 10 companies. This is a chart from Bloomberg Intelligence and Bloomberg Opinion, which tracks AI as a percentage of the index's weighting. And then it also has compute infrastructure AI power percentage. So some different names there, different groups. But you can see it right now, the S&P 500, about 45% of it is the AI theme, which is pretty substantial. And when you add on compute infrastructure and AI power, it gets closer to 52%. You can see the tech sector is even heavier weighting towards AI, which is no surprise. Communication services is even higher. But then you even go into sectors you wouldn't think that are related, but utilities down there, the utilities ETF or index. Obviously, most companies are looking to create partnerships with these hyperscalers to power these data centers, and Bloomberg's research put that number at close to 95% of these US utility providers. So really getting concentrated, really having a few number of companies impact the rest of the market, and probably will continue, especially with their sheer size and the amount of capex that they're continuing to commit to. On a bit of a lighter front, we'll look at the gold prices here. This is just central banks' purchases of gold by month. You can see the blue line is gross purchases. The purple line is gross sales. In March, we got net sales for the first time since January, where there was slight net sales. Prior to that, you'd have to go back 2 years to March of 24. There was 1 month, but there was net sales. Obviously, some seasonality here, and depends on the price of gold. But in April, we got back to a net purchase by central banks. So continue to think that there's a bit of a floor price in the physical market for gold. And speaking of, this is just gold holdings as a percentage of foreign reserves globally. Earlier or late last year, earlier this year, for the first time since 1996, gold overtook U.S. Treasuries as a holding as a percentage of foreign reserves. So really seeing that rotation. And if you really began, I'd say in 2013, where some of that purchases began, but really started to accelerate in 2020 and especially over the last 2 to 3 years, where countries are looking to diversify away from the US dollar and into assets that I'd say can't be manipulated as much. And I think that's it for me. So I'll pass it back to David.
Yeah, those some great charts there, Ken. Good stuff. Thanks for that. Hi, everybody who's just joined now. Yeah, I've been away for a couple of weeks, so this is it's good to see all this good stuff going on the markets are on fire, to say the least. So here we go. Oh, here we go. Come on, computer.
Hi, welcome to this morning's morning brief. My name is Joe Tizzolo. Today is June 4th. Jumping into action yesterday, pretty negative day across the board. Major market indices fell yesterday. We did see crude oil up about 2.5%. The dollar was also up as well. Small caps and emerging markets were hit the hardest yesterday, with the Russell 2000 down 1.31%. When we look at commodities here, crude oil obviously is grabbing all the headlines with the conflict in Iran. On its 2-point chart here, I'm sure we've been highlighting it through a couple of these videos, but this kind of mid-low 80s level has acted as pretty strong support since the onset of the conflict back in March. And we saw a reversal back so far this month, up at $96 a barrel for crude here. So we have a pretty well-defined range right now. Dropping below 80, I think, would be a good sign for anybody worried about gas prices. If we start to creep up into the above 110, then you start to get really, really worried at that point in time. But for now, we're kind of just established and right in the middle of this range we've been in for about the last 3 months. One commodity that's kind of continued to move higher is copper, and a lot of this has to do with the AI build out and demand for materials here, but this has continued to push higher, forming a double top at all-time highs here at $6.64. So we'll see what happens here, but from a commodity standpoint, while we have seen precious metals calm down a little bit, copper continues to move higher, and this is stoking fears about inflation, rates moving higher, that sort of deal. One area where I do see the inflation stuff, it may not be as much of a worry, is when we start to look at the health of the consumer. So this is the Amplified Digital Payments ETF, iPay, and this is pretty much just looking at all of your payment processors and those sorts of stocks. So ranging from American Express to buy now, pay later names are in here. And this has been pretty weak, right, for quite some time. Miles put together a good piece in the report yesterday about false breakouts. We actually see 2 false breakouts here on this chart. iPay, moved back to a positive trend following the tariff tantrum in the summer of last year, failed to take out the old high, and then moved to a negative trend. We saw something similar here where Iran conflict starts. We see that move down to around $41, although it had been heading lower for quite some time. We see that rally with the broad market in April, and then this thing has kind of rolled over to make a kind of another lower high, a major lower high here, and moved into a negative trend yesterday. So this is one area where I'm really focusing on, because if that kind of short-term disruption in the commodities complex is unwound, I'm not sure if we're going to be able to see, the demand side really start to stoke inflation here. So a lot of it's supply side constraints right now, but from a demand perspective, we've seen that kind of deteriorate over the last few years at this point. Moving on to our next chart here, over to this semi-AI trades. Broadcom announced earnings yesterday after the close, was not received well, down about 14% after hours, trading around 411. Interesting spot on its chart. We see support here at 396 to 408. So right, pull back close to this support area as long as it opens here in the next 2 hours. We're recording this as of 7:30 Eastern time. But pull back from heavily overbought territory. Yet to give a sell signal that could obviously change during the trading session today. But interesting. This is kind of the first name where we've seen an AI or semi-stock not act well on earnings. So we'll keep an eye out for this one. And then lastly, the last 2 months, I mean, there's a lot to be worried about with the Iranian conflict, health of the consumer, and all sorts of deals. But when we look at the market returns over the last 2 months and the rally not ending on, but the 2-month period going back from pretty much the end of March through May 29th, the S&P was up almost 20%. Looking at other rallies like that over a 2-month span, usually are pretty good for forward returns. If we look at this table here, average forward returns are really strong. There are some negative instances in there. The interesting thing about this list is most of these are coming off major market bottoms. So, we look at something like 82. If you have familiar with market history, this is kind of when rates peaked, right? When you could get like 18% on a treasury bond, which is, crazy to think about nowadays. And then, 1991, you did have like that brief recession there. You had 97 and 98, which were not as bad, right? That was during a bull market run. Continued to put higher for several years. Then you have May 2009 coming right off that bottom, May 2020 coming right off that bottom, and then April 2025 coming right off the tariff bottom. And then this time you have it coming off the Iranian conflict bottom. Although the severe pullback or the severity of the pullback or how far we were from all-time highs at the start of this rally, we were only down about 9%. The only kind of allegory we have is 1997 for something such a mild pullback leading to such a strong rally. Also, we only see the trailing 1-year return for the S&P was positive only during this instance, the most recent instance, and then in June of 1997 as well. But you really can't argue with the forward returns here, especially over the next few months. I mean, 3-month return of almost 10% on average is exceptionally strong. So until we really start to see price action deteriorate, there's not too much to do other than kind of sit on your hands and enjoy the ride, at least for now. Now, there are some sectors that are doing quite poorly. But if you're in the strong stuff right now, you kind of just got to hold on to it until it really starts to prove otherwise. With that said, we'll go ahead and wrap up, and thanks for joining us this morning.
Yeah, that was interesting. Some interesting history there. Like that guy. Okay. Michael Coolbaugh didn't come through with anything because he's just written up his annual commentary, and I thought I expanded this already. His results have come into the end of May. That's nice and quick. He's up another 2.4%. He's up over 15% year to date. This guy's just hitting it out of the park. And he's just like a macro manager for us. So good for him. I'm not going to go through actually, I've got it on the PDF here. Actually, everything's over the PDFs. Yeah, I'm not going to go over the insider issue, but if anybody wants it, just reach out to me and I'll flip it to you in PDF form. But they're talking about a commodity super cycle. They're seeing Brazil as a some interesting country to invest in, and so on, all the way down here. And then, of course, they put their big four, big five ideas of on the buy side. Be interesting to go back and track those as to how they've done. Wonder if I could get AI to do that. But yeah, so let me know if you're interested in that. Just the asset class performance here. So everything is green except for India, and Canada is almost at double digit now. S&P, US is bypassed with the NASDAQ being one of the leaders in Japan. Incredible year to date, up 35%, even with their high interest rates and everything. I guess that's really an inflationary region that the stock market has been the place to hide out there. We've heard enough about energy and crude oil and that. I'll take that one. Sorry, people. Yeah, so it looks like oil is up a bit here, so it's tracking nicely, as is nat gas. Gold's taking and silver taking a bit of a rest here, and we heard that Ken, I guess, was talking about copper doing quite well. I'll cover the Canada US dollar and these other ones with the point and figure ones. Gary Schilling's report just came out. I've sent it around, shared it around with those, so you'll find of interest. And I always like to go to his, just the summing up first. It's just so much to read in this business, as you know. You can't read it all, but yeah, so not sure what he's saying. Comments about Kevin Warsh coming in. It's going to be hard for Trump to get his way when it looks like they're going to have to be raising rates just to try to get in front of inflation, which is a problem, rising mortgage rates and so forth. So I'll take a read of that later. Here's Michael Coolbaugh's letter. It's an 8-pager, and he does a really great deep dive around the world and where he's seeing sector performance growth. And I haven't read it yet, so I'll have to allocate some time for this. But it looks like he's getting into AI and putting them into categories as to which ones do what. And that's always good to know. Sometimes you get stuck just using one of them, and that might be the appropriate way to do it. Here's one chart: US dollar versus the Japanese yen in black. And yeah, so that the yen is getting much weaker relative to the US dollar. So I'll take a read of that later. And then finishing up here with the playbook. Okay, my computer's getting sluggish, so bear with me. Okay, no change in the Canada US dollar, although it's down a bit since I've been away. It's from 73 cents down to 72. And the trend on the short term and long term are down to 70 and 62. So at least point and figure is telling us to not worry about our exposure there. The US dollar spot index is at 100, measuring down to 95, and really has done nothing this year. But they're going to continue to try to push that down. And okay, so crude at 96 measures higher to 109. That's a change. And nat gas measures slightly higher. The producers all point that way as well. Yeah, according to this, copper has peaked out, up 15% year to date, and looks like it might be leveling out. And this is just mathematics. of Point and Figure. It's not anybody's opinions or any analyst's intervention. This is just pure mathematics. Uranium looks strong again. So does gold. I jumped one there. Yeah, so the gold futures have peaked out right now, whereas the spot price shows higher to go. And both the gold bugs and the VanEck majors all measure higher. Really not much movement this year, though. So after a very, very strong move last year, it's hard to keep up to that. The juniors measure quite a bit higher. Now silver looks to be peaked out on both the commodity and the producers. Yeah, Bitcoin has been slapped since I've been away down to 64,000 and with a target of 22,000. So not very strong. And looks like this is rolled over too. Ethereum measures down and Solana measures way down, as do the crypto index. So the digital world has really rolled over and changed in the past 2 weeks. Well, everything else, money's just flowing into other strengths of the market with the techs and AI grabbing it all again. The banks, bank majors look strong. The regionals look very strong, and the Canadian banks look very strong. So lots of money continue to be poured into those, whereas the brokers look to have peaked out. And finishing up finally with interest rates. And start with the 2 years now up to over 4%. That's quite an ascent since I've been away. So that's quite a move in 2 weeks, up 16% year to date. And it measures up to 5 3/4. So yeah, the Fed's going to be forced to move rates up to sort of keep up with the reality there. And the 5-year measures up, the 10-year measures up, and the 30-year measures big up to 6.2%. Yeah, that's very inflationary. You've had the greatest movement in the 2-year and then the 5-year and the 10. So the short end's got all the returns, but it looks like the long end wants to start catching up to that. And I think that's it for me. Just saw you on the list there. Yeah, there you are. You want to take it from me?
Okay, here's the macro overview. I don't have my performance. I've taken some money out, screwed up the calculation. I'll get that back soon. Positioning, just lower capital exposure due to the Iran war. You know, the ceasefire, as Trump said, you know, like the ceasefire means just moderate shooting. Iran has surprised the U.S. axis in the intensity of their attacks in the last couple of days. They seem to have a lot more in reserve than everybody thought, and it looks like the Republican Guard is taking control of the company with the rumor that the president had resigned. This is kind of what I expected. The Republican Guard, as a self-funding army, is going to be looking to do business beyond the theocracy. The theocracy is generally hated by the broad population. So I expect essentially a military coup and then the resumption of negotiations. We'll touch on that on the oil slide. Right now I'm long biased. I've got a thesis on Apple that we will discuss at the end. I still have a bit of silver, copper, defense stocks, looking at the debasement trade. And unfortunately, I still have some crypto, which is just a disaster of an asset right now. I am generally beta hedged at this time using futures. In summary, the crypto market is fragile with the risk of breaking much lower, kind of, you know, mirroring what Dave said. We take a look at the past month in the asset classes. You know, Bitcoin and Ether just hammered. Crude is down. The stock market is up. despite the US dollar having a bit of strength over this period, we're seeing a strong trend in sovereign rates rising, and now we've flipped from like 2 cuts to potentially 1 hike, and that's hurting hard assets like gold and Bitcoin. Economics, not much change here, except the bias in the Fed and right now is 1 hike later this year. Unemployment still on track in like the mid to low 4s. Inflation is going to be well above target. PPI has shown this. Growth, 3% expected by Atlanta Fed. The ISM came in at 54, expansionary. Right now, recession, not now. Risk continues to rise on high oil prices. Commodities are just turbulent. The US dollar is like very choppy. And rather than hold a non-debasable asset like gold or Bitcoin, people would rather be taking positions in where they get to earn yield. Here you can see the US dollar just chop sideways for the past year. The administration wants this dollar lower, but we are still in a risk-off flight to quality mode in many ways. The yen carry trade, we had a nice intervention for which I benefited with the position. And now we're drifting back up to the 159, 160 level again, which is likely where the Bank of Japan will intervene again. I don't know, if they certainly have the US dollar reserves to continue interventions. They just continue to fail to hold. And we could see at some point the hedge funds gang up and do a Bank of England Soros type attack at some point and see if they can really break this thing well past the 160 level. Gold, gold is just not looking great. It's got negative momentum across the board. If you look at the heat map, we've got red top to bottom. We've got a downtrend. We're about to break the 200-day moving average. I think rates are saying like I'd rather hold something and earn 3.5–4% interest than play against a potential debasement trade. Silver, same thing. Although I do expect demand for solar and industrial use to rise once we get going again. I've got a smaller position. Again, this isn't exactly an investable asset. I don't see any momentum. We see red top to bottom in the heat map. Just keep the position small. Oil's about war right now. Trump talking a big game, but at the end of the day, Iran, I think, is just going to play the waiting game. They know he's got midterms coming up and that high oil prices are a disaster. And all of these companies had, 2, 3, 4 months of chemical supply, downside supply for their industrial products use. And we're now getting to the point where their tanks are emptying, and we're going to hear a lot more about that in the month of June. We're seeing massive draws out of the Chinese strategic reserves, and they're basically using that to win favor with many emerging market companies. Now, let's remember one thing here is that Israel's goal is not going to be met until the nuclear material is removed and the ability for enrichment is gone. And that is nowhere in the cards at the moment. So I just don't see a lot changing at the moment. We're, seeing questions about who's actually in charge in Iran right now, and I would expect that the Republican Guard is going to come to the fore and fully assert itself over the next month. Rates and credit, continue to be pretty boring. Frankly, like not much has moved. The yield curve is about where it was. Mortgage rates are about where they were. Credit spreads are about where they were. They're historically low. A lot of people are still watching this. You know, if Japan continues to sell their treasuries to fund interventions, we're just going to see a lot more pressure on U.S. rates rising. The equity market has slipped from greed to neutral, which is interesting given how strong the performance has been. I have to say, when you do the statistical analysis of, say, this rally, we are at an extreme. Like, we're talking Sharpe ratios beyond 6. I mean, we're probably pushing over 7 now. The volatility has come down. We're seeing spot VIX at like 16. So this neutrality does surprise me a bit that we've slipped here, but maybe the rest of the world is thinking this is as good as it gets. When we look at earnings, the analysts are just so bullish. That thick red line is expectations plus current year blended together. And it's just an incredibly strong uptrend. Now, that is going to be very interesting to see what happens when a massive company like SpaceX gets included in the index. I haven't seen anyone talk about this yet, but you know, it's a massively unprofitable company. So we could see, you know, like the S&P 500 PE move up to a record. We'll probably, you know, we could see the Shiller Cape move up to an absolute record here as well. And then we'll hear more chirping about valuation just by the inclusion of SpaceX in top 10 weighting. You know, here we see the Shiller price earnings ratio. You know, it's the 10-year average approaching, you know, the all-time highs of 44. We're at 42.5, and you know, this is starting to feel to me a little bit like 1999, where we're seeing exuberance on what AI can do. And I use AI every day. I'm into the, I've gone through OpenClaw. I'm now using Hermes Agent, which I have to say is what's going on in that space is absolutely mind-boggling. I think computers are just going to need more and more RAM going forward. They're going to need bigger chips. The S&P 500, we've just seen an absolute ripping recovery. If you can't go public now, if you can't raise money now, you're just not trying. We've got SpaceX, Google, Anthropic all coming, massive deals coming. You know, SpaceX very unprofitable, Anthropic barely. Google, I still like. You know, this is just incredible. Like, we're not seeing any slowdown in the index. We have like broad support at like 6,800 to 7,000. Could we retest that? That's kind of what I think is going to happen, but it certainly isn't happening right now. So when we look at the heat map, the trend monitor, and the breadth monitor, they're all saying you're fine to be in the S&P 500. However, I do recommend, and I continue to recommend, that people consider to hedge some now, like a 1% put spread, or 1 to 3% in a 3-month put at like a 660 strike. I'm short. I've hedged some of my beta risk with S&P futures. However, I'm thinking of flipping over and just trying to get some leverage to a potential correction that, you know, is sized appropriately. Like, there's certainly been massive outperformance in the index. Crypto, it shouldn't say better, that's for sure. I'm just going to change that on the fly right now. It's bad. Okay, Bitcoin has faltered as a debasement trade. It's a broken risk asset. I continue to say the downside could be 45,000 into the fall. You know, I'm seeing seller after seller. I fielded 2 calls of people with in excess of $40 million personally in the last 2 days, and they're starting to lighten up. Michael Saylor is sold, and that's like a that is literally like ringing the bell a little bit, because he swore that he would never sell, and then he had to sell. Is sentiment going to get better? Well, theoretically, this Clarity Act is passed. It's got to be signed and worked on a bit. But we're seeing things like Coinbase laying off its 14% of its workforce, and they're front and center. So we're in a Bitcoin bear market. We're down 20% from the recent high just like a month ago. Higher rates are going to continue to hurt this. And right now, nobody needs Bitcoin, right? Like it's just become a useless asset because people would rather trade earning interests than protecting against debasement. And debasement really hasn't ramped up yet, and it won't ramp up until we see the money printing come out of the Fed, and that looks like it's off the table until oil breaks. So my favorite trade at the moment is Apple. I've been an Apple fanboy for 30 plus years, maybe 40 plus years. Their Worldwide Developer Conference is next week. They've got a new head appointment. Tim Cook is moving out of the picture. The biggest thing everybody wants to see is a Siri reboot, where you can choose your model, Claude, OpenAI, whatever. I'm running, all of this stuff. Siri is dumb as a bag of hammers, as many of us know, despite it being around for 15 years. There's a lot they can do, and I think the new guy will overcome a lot of the political correctness that, flows through the veins of Tim Cook. And hopefully they will rationalize and start getting these new M5 chips out and their new high-end phone chip. I tried to buy a Mac Mini the other day to set it up for agentic computer use, and it's a 2-month back order. The guy said, like, they haven't had any in the store, they can't sell any. Like, if you're 2 months behind on one of your flagship products, something is really wrong. You could say, oh, there's all this pent-up demand, but you're missing sales. You're missing sales in a huge way. That this has been going on, talking to them for at least 2 months. They've been in permanent back order. Even when I tried to step up to a studio, I was looking at, I think, 2 to 3 months to get a computer. This is insane, right? I understand that memory is expensive, but people are willing to pay up for it. Really, the only choice you have to get anything quickly with power is a MacBook Pro, and even that is 4 to 6 weeks. So they've got to get their hardware tuned up, and they've got to get Siri working. When the average person sees the potential of AI through Siri, and ideally is able to use it agentically, I think we actually may see another big wave of enthusiasm for AI. And after it was reported that the Trump Family Trust did 3,700 trades, I thought that this was appropriate, where Trump is like, millennia, we need to have more kids. That's it for me.
That is very good. I think that's the most fun part of your report.
I like it.
Really good. Okay. Chris Curry, you still there?
Yeah. Yep. I'm here, Dave. And just quickly go over a few things. Tomorrow, got the non-farm payrolls in the U.S. The forecast is for 85,000 jobs created. Last month, there was 115,000 jobs. U.S. economy, I mean, everyone knows it's strong. And Q2 Atlanta Fed GDP now estimate is at 3%. I would say, though, in the bond market, things are feeling, in Canada, pretty heavy. Dealers seem to have a lot of paper they're trying to sell. In the U.S., the 2s30 spread has tightened quite a bit. And that's driven primarily by, the rise in the 2-year. The 2-year at 4.03 with Fed funds at 3.5 to 3.75 is implying that, the Fed needs to do a 25 basis point hike, which is in the cards, but not till March 2027. So, whether the Fed catches up to the market or not, we'll see with the new chairman. the third year also helping to tighten that spread as the third year has come down from a peak of 5.20 in mid-May to 4.97 now. And then lastly, just want to talk about the Canadian dollar. Has really sold off. It's been a real disaster area. As Sean says, nobody wants Bitcoin. I was thinking when he put that slide up, he could put no one wants the Canadian dollar. I wonder if the markets may be expecting a politically driven cut from the Bank of Canada, which would, problem with that's going to destroy the Canadian dollar even more, because that would take the relative interest rates with the U.S. to an even wider spread and sort of obliterate the dollar. So Canada is in a technical recession, 2/4 of GDP, the only one in the G7, which Pierre Poilievre is not short on commenting on. And that's, I guess, on that note, I'll pass it back to you, Dave.
Okay, thanks, Chris. Paul, take it away.
Hey guys. Just a couple of points this morning. Very exciting news out of Potland today. TrueLeaf just announced about an hour ago. I just sent it a Canaccord view on it, but TrueLeaf has decided to spin out their cannabis non-medical business into a separate asset that they're going to own, but they're going to equity account for. So they're basically, taking it off the books from an accounting point of view, which means they only own medical, which is now, I guess, legal, federally legal in the U.S. And that means they're going to uplist to a U.S. stock exchange. And this will be the first ever uplisting of a well-run U.S. cannabis company. And it is very well-run and quite profitable. The stock trades at under 5 times EBITDA. They've got a strong balance sheet. Okay, so you have all of what you'd look for in any kind of investment, right? High quality company trading at a very low multiple, with good balance sheet and good business prospects. The stock, in my mind, this thing lists on the New York Stock Exchange. So it's under a $2 billion company, right? It used to be, 6 or 7 billion. So the thing's been completely beaten up. They are the dominant player. And I just don't know what you wouldn't like about TrueLeaf as an entity. And I think once you list on the New York or NASDAQ, I'm not sure which exchange they're going on, but they are going to uplist, is the result of the news today. This stock is going to double and maybe triple between now and Christmas. So this is a great opportunity. It's a big part of the MSOX and the MSOS, I guess, and the MSOX, the doubler. Anyway, it's like, I think, the second largest holding or the third largest holding in that ETF. So that should do well. And then a whole bunch of these cannabis companies have, in fact, started to do consolidations. So, doing a reverse 5-for-1 stock split. And the only reason you would do that is if you're considering listing on one of the U.S. exchanges, right? You've got to be at above $5 US per share. So the biggest one did it, Cura, and our favorite Verano just did it. And so anyway, they're doing it. I think that's a good indication that they think there's a high likelihood that they will be able to uplist. And frankly, I don't care what anybody thinks about cannabis and all that. I'm not a big cannabis fan myself, but I mean, in the investing business, when you can take an industry and take it from being on obscure stock exchanges in foreign countries like Canada's smaller exchange, the CSE. If you can go from that exchange to the New York Stock Exchange, you are going to get, and you're a U.S. company, you're going to get a dramatic lift in multiples. And So I think it's very interesting times. And so now, anyway, truly, it's happened as of this morning, and none of us are too late. I don't think we're going to a 5% position on the fund. So I think that's exciting. These markets, as you've been talking about, are quite volatile, very tricky to manage. But I think there's value everywhere in the Canadian market. So 45% of our fund now trades at less than 4.5 times EBITDA. So let's call it, we'll go to a 5% position in TrueLeaf. You could argue that 50% of our fund will trade at less than 5 times EBITDA. I mean, there's just value all over the place. And so, we can't avoid putting our money to work. Because as you know, the rest of the markets don't trade anywhere near those levels. So I think there's lots of opportunity in all sorts of sectors, and we'll see what happens in Iran. My biggest fear is that we don't get this thing solved in Iran, and we start to have global, not only energy crises but food crises. And I don't care what anybody says. Everybody's ignoring what's going on in Pakistan, for instance, or Bangladesh, or Indonesia, or perhaps India. You can ignore it all you want, but when people are suffering in those countries, which is like multiple billions of humanity, the stock markets aren't going to like it, right? And so it's kind of like an inevitable freight train running at us. And so I certainly hope we get this resolved in the coming weeks. It doesn't look like it's happening, but so you have to prepare for a spike in energy prices, but also a spike in food prices, and serious ramifications in those parts of the world, which is not going to be pretty. So this is all a problem from the supply side, not from the demand side. Everybody in the financial markets focuses on the demand side, and it seems ill-prepared for supply shocks. So I think that's the biggest risk we're facing right now. And then I'll leave you with one other thing this morning. If you want another thing to worry about, on Bloomberg, there's an article, this woman from Goldman Sachs, I think it was, opined that there's $230 billion in debt in the US in the broadband space. So basically cable companies and telephone companies providing broadband services to the population. And of course, SpaceX, buried in SpaceX, half the value is in Starlink. Starlink's doing tremendously well. And there's a theory out there that, once Starlink SpaceX is public, Starlink is effectively there. Musk is going to go after the broad consumer, right, for broadband, because it works so well, Starlink. And maybe they'll just go into the urban environments in a more aggressive way. And so guys Rogers, is Rogers prepared for this? They went and bought Shaw Cable, right? And they paid top dollar, and they issued no equity. They borrowed all the money, and they basically bought a cable and broadband business, right? Plus cellular. But anyway, how are they going to compete against a global satellite business that provides, terrific broadband services? So I'm just not sure anybody's figured out how this is all going to play out in the next couple of years. But I would suggest to you that it's not going to be good for Rogers. It's not. They're going to drop the price to, I don't know, $20 a month, and Canadians are going to flock to that service. And they have all this debt. How is the debt going to be repaid? So $230 billion of broadband debt needs to be refinanced in the next couple of years. And how well is that going to go? Who wants to buy bonds in this kind of business? I'm not sure. So there's the equity component, but the debt side is she's warning anyway is a very big issue. So I'll leave that for you to consider. I mean, I'm not sure you want to be in the owning Rogers or TELUS these days, right? If you looked at their balance sheets, And you look at what they do for a living, and then you look at these competitive threats that are coming. May as well buy Telsat, which is now our largest holding, because the stock's done so well. Buy Telsat, which is going to compete against Starlink and do exactly the same thing, only they have, we're being told, better technology. So I think it's an exciting time in the space area. And anyway, that's what we're doing. And that's it for me.
Good stuff, Paul. How do they get their satellites into outer space? Are they using any of Elon's services, or do they have separate rocket programs?
Yeah, SpaceX. They're all booked on SpaceX. Have been for a year or two.
Mm-hmm.
SpaceX has yet to not deliver. They've got a very good track record of getting stuff up there, right?
So that would make them a little bit more expensive than the Starlinks of the world?
Good question. I mean, Starlink's already up and running, and it's already got, thousands of satellites. Telsat's not going to have thousands of satellites. They've got a different kind of configuration, but it's, hundreds. And they're supposed to be up and running and commercial by Q1 of 28. So basically 18 months from now, call it 2 years from now, which in satellite terminology is like tomorrow, right? That's very short term. That guy, Dave McFadgen, believes that Telsat could be a $500 stock within 18 months. $500. It's already tripled. And he called us a while back, and he's adamant that the market hasn't figured it out. And anyway, the valuation of Starlink now in SpaceX, right? It's over half the value. They're saying it's 60% of the value. Anyway, round numbers, it's supposed to be worth $1 trillion. $1 trillion. Well, if they're worth $1 trillion, what's the value of Telsat today? It's less. It's $6 billion US enterprise value. Okay, so $3 billion in capex, $3 billion in equity, and a couple of billion in debt. So we'll round it up. We'd be very conservative here at $6 billion. Well, that's less than 1% of the value, and they're going to be competing head to head within 2 years. Well, I mean, there is no doubt that the clients of Starlink around the world are going to be very happy with Starlink. They're going to love it. They're going to say, "It's fantastic, but you're our main supplier." Blah blah blah. But many of those clients are going to want to buy some redundancy, some backup. So when governments, military, there's no way they're going to go with Elon Musk alone. They're going to look for alternatives as well. And so we think Telsat's going to get a lot of business from big governments around the world, right? I mean, that's kind of an obvious thing. And you're at 1% of the value. So McFadgen's going, that's ridiculous. It's going to go to, I don't know, 5% of the value. It's not that complicated a thing to forecast. So anyway, yeah.
On the SpaceX, I mean, it is like literally the worst governance I've ever seen. It makes crypto governance look like the U.S. Constitution. I would expect that SpaceX is going to buy Tesla.
Right.
Like Musk is completely like sovereign in the way that SpaceX is set up, and he continuously was complaining about the fact that he could be voted out technically from Tesla. Tesla is just not going to do well against the Chinese cars, and it's a way of entrenching himself and protecting Tesla from basically being slaughtered, is to bring it into SpaceX.
Right. And obviously, Musk is now running two companies, right, at the same time. So
Well, he technically runs Neuralink as well, the boring company, and he's got apparently 22 children.
So the thing is, the stock market's going to be griping and whining about how much time he spends between just his two public companies, right? They're not going to whine about things that they don't know about, but they're going to whine about between Tesla and SpaceX. And so you can just hear it, 6 months from now, everybody's saying you should put all this together into one company. And of course, if we're going to value his, I mean, he owns 85% of SpaceX. Is that true? I mean, I'm not sure, but anyway, he owns a huge chunk of SpaceX. He's gonna be the richest guy in the world. He's gonna have total control over that, multi-voting shares. Well, why wouldn't he just go buy Tesla at any value? That way
Yeah, I expect him to do that. Like I'm a subscription user of Grok. It is just not going to flourish. Let's be blunt. Anthropic Claude is doing it right. They are going to own the corporate market. Recruiters right now, if you know how to use Claude Cowork and Claude Code, you go to the head of the list. And if you don't have that ability, it doesn't matter whether you know how to use OpenAI, Codex, Grok, whatever, right? They want, for people that are looking for risk management finance jobs, they want people that know Anthropic Claude, full stop, and how to use it within the Microsoft suite of products. But Grok is ultimately going to fail, and I think that's partly why XAI agreed to give so much compute power to Anthropic Claude. But I still see, like the 1999 echoes are there in this space. It's like everybody is blue sky. For example, right now, I cannot get AI to replicate my deck the way that I'd be satisfied to do it. Despite paying, I probably pay close to $400 a month for various subscriptions. To me, that seems a little bit ridiculous. The productivity lift is still not there, but I can see where it is coming.
So given that Musk needs so much money to do these different business initiatives, I mean, this is the ultimate con, right? He's convinced the world that you got to buy his SpaceX, and what the reality is, he needs like 75 billion just to be playing in these industries. So he's conned everybody into giving him a huge valuation and multi-voting shares, and he's in charge, and he gets paid, and all of this stuff, and he's going to raise 75, and then the business model means he needs to raise $100 billion a year for the next 3 years at least.
Yeah, so, well, I mean, the Roadster has not appeared. The semis have barely appeared. Full self-driving has not come to pass, despite him collecting $10,000 per car for over 7 years. There are a lot of promises. They do fantastic launches. Their cars do work, but the robo-taxi thing, without LiDAR, I just don't see it working. And now with the Chinese competitors entering North America, like in the southern US, people are going to Mexico to buy BYD cars.
Yeah. So if he buys Tesla 8 months from now, is he going to buy it at a low, or is he going to buy it after it's?
Oh my God, he's not. He is going to basically bribe shareholders, and you're going to get SpaceX stock, probably at a 20 to 50% premium. So that might be a trade I put on, like a 9-month call option type trade.
Can you put it on Tesla? Because
I would put it on Tesla.
They're going to get the premium. It's a very difficult thing to call, because he doesn't have to pay a premium to Tesla, because all those damn Tesla shareholders are going to be very happy to join up with with Musk in SpaceX, right?
Yeah, you're right. It is a cult stock. So,
well, guys, we better wrap it up. This has been a really good session. I missed this for a couple of weeks, so thanks for everybody's input. And Joe and Ken, stay on. We'll do our monthly video.
Thanks, guys.
See you guys.
See ya.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.